Let's start. Today's session is 12th day, and today our topic is the exempt income. Exempt income and what is the city law article that already mentioned, the article 22 of city law, and how many exempt income we have. So how many exempt income we have? So we have 4 exempt income. So that we're gonna discuss in detail. So which are the 4 income and how it will be gonna move forward. So I shared 2 or 3 article also in the group. Hope you guys notice that and you work on that. Let me see one more thing before starting today. Yeah, fine. So the first exempt income dividend received from the local juridical person. So earlier we also discussed throughout our the sessions that local dividend is always exempt from the UE resident company, UE local company in different uh, on different the while discussing the throughout the session we are discussing the what are the exempt and one by one, but now all the exempt income in this session we're going to discuss. The dividend income we will take from the UE resident person. So then there is no condition. If you receive the dividend from the LLC company from UE base, so there is no condition. What are the conditions? The condition is normally we will see the participation exemption. There will be some condition. 5% shareholding or 4 million. Okay. So if we have such condition, we will see in the participation exemption, foreign participation exemption. We have such requirement, but in case of local dividend, we will not look into such condition. We just see dividend received from the juridical person, local. So here I already highlighted the local juridical person. Okay, the one is the local and the second is the juridical person. So this both have the meaning. Both have the meaning that we have to focus on that. One is the juridical and one is a local. So this is the now how the juridical mean the LLC. And the local mean the UE. Why I'm highlighting that, guys, please excuse me regarding my handwriting. I'm trying to write with the mouse as whatever the possible. Now these conditions are not relevant. These conditions are not relevant. Now we have to ensure this local dividend we will not receive from the sole establishment or the unincorporated partnership, because we mentioned the LLC. We mentioned the LLC. So hope this point is, if we receive the dividend from the sole establishment or unincorporated partnership, then it will not be exempt. Now, hope you understand the local mean the UE LL juridical person, and this one also is understand what is the definition of that. Let's move to the next partnership. Participating interest exemption. What is the participating interest exemption? Anybody would like to explain what is the first meaning is coming while discussing the participating interest exemption? I would appreciate if somebody is wish to participate. Please, guys. Participating interest, Article 23 of the city law is dealing with the participating interest exemption. Participating interest, if you take the understanding, what is the participating interest? Let's say we have one company. Okay, now I'll add the both example also. let's say I'll just mention the UK. This is also LLC and this is also LLC. So this is the, let's say I'm gonna see we means any of the company. He have the shares. Shares in UK LLC company. And on the same time, he may have the shares in the UE LLC company. So if we UE company, okay, UE company, why I'm here mentioning the UE company, because we are discussing the taxable person from the taxable person point of view. So here the UE company is a taxable person. From his perspective, we are looking if he made the investment or he buy the share, okay, in UK company and in the UE company. So this will be local. If he buy the share, what he will receive? The dividend. And if he invests in the UK company, he also receive the dividend. What other thing he will receive from this company? What are the other possibility that he will receive from UK company and the UE company? Anybody would like to answer on that? Okay. First, he have the shares. Okay, we will see the dividend. Second, if he sell the share, so he will be subject to capital gain or loss. The same will be here also. Capital gain or loss. So if he, so we said the local dividend, whatever the local dividend is receiving, what is the local dividend? Exempt. Dividend received from local juridical person is exempt. Okay, so how about the, now we still have the dividend from UK company, capital gain or losses from UK company, or the local capital gain or loss. So dividend local company is always exempt. Now we have to see that this dividend is receiving from UK company. There is some additional condition that we are saying the participating interest exemption. So this is the meaning of the participating interest. So now this, what is the condition of that? It will be dealing by city law article 23. So mainly we are saying the 5% shareholding. Let's say he have 5% shares. One condition is that. So he to claim that he must have the minimum 5% shareholding, or the other is 4 million AD. This is the second condition. Apart from that, there is other condition also. In detail, we will go through, but this is the primary two condition, but there is still other condition also there. The primary is these two condition. So if we have to claim this participation exemption, then we have to see this condition are meeting. If it's meeting, so the dividend income and the capital gain will be exempt also, subject to meeting the participating interest exemption. Okay, guys. I think due to some internet or something is disconnected. So be careful while disconnecting. Maybe the host will be changed by default. Okay, now first is the dividend from the foreign subsidiary, and the second is the capital gain or loss on sale of shares. Under capital gain and loss, what is the next point? So let's see. Capital gain and loss on sale of shares, local company shares, because if you sell the local company, you will have the capital gain and loss. The next is the foreign company. Then the foreign exchange gain and losses. If you have the participating interest, then the value of that interest may be the increase and decrease. So then we have the impairment gain and losses. All these are falling under participating interest exemption. So then we will have the next is the no participating exemption on below income. If this below incomes are coming, then there is no exemption. For participating interest, we already seen the local company shares, foreign company shares, foreign exchange gain and losses, impairment gain and losses. The next we are saying these are will not meet the participating exemption criteria. What are these? Rental income from the participation exemption. Let's say the one of company that we have the shares, let's say the 5% share in the UK company. So if we have the shares, then we took some property and give to that company also. So then now we are receiving the participating interest dividend, plus we are receiving the rental income also. Is the rental income will be part of participation exemption or no? Because rental is another activity. So that rental is another activity. So that will not be come under the participation exemption. Now the next is the royalty income. You are receiving any royalty where you pay patent, trades, mark, or any copyrights, or the brand or something you already give to the same company. You are receiving the income against that. That also will be not meet the criteria of the participating interest. The participating interest definition we already discussed, but now just to refine that for enhance our understanding, because these are the common thing that mostly the industry or the businesses are using. Now the interest income, the loan we give them, you will not meet the definition of participating interest. Management fee. Now the management fee, interest income, royalty income, some financial institution or some holding companies, mostly some investment funds. There's a different broader definition. Sorry, there's a broader definition of investment fund, but there is some companies in the UAE also. I had the one meeting also in one of the company who's providing the same investment opportunities. So they have the funds from all over the globe, and they made the pool of the funds. Now they are investing that funds to the different, the companies in UAE or international. So they have the portfolio, they are investing over there, but so now they investing over there and they are receiving the income from there. Then they are giving that income to the investor who give that money to them. So who given the money? So now from that investor, what he is charging? He's charging the management fees. So they have 1%, 1.5% in management fee. Plus they given the cash in one of the financial institution. So whatever the pool of the investment, so normally they take the management fee. This is the main income of that, of the financial, the companies who's doing the investment activities. So they are charging the investment fee. So whatever they buy the shares and they're getting the dividend, that is exempt, that is meeting the definition of the participating interest. But apart from that, they are charging the management fee because from the client, on behalf of them, they investing somewhere, and to cover their expenses, they have management fee. So that management fee, even he's taking from another company where he invested the funds, they will not come under the participating interest. This is the one of the example I just shared. from the practical life. Let's see the next, the debt instrument. So these are the comprehensive list just for our understanding, but our main scope is dividend from foreign subsidiary, then capital gain and losses on sale of shares, local company as well as foreign company. Now the third point, the third income, foreign permanent establishment exemption. Now, what is the foreign permanent establishment? What is the foreign permanent establishment? Any participant would like to volunteer and explain what is the foreign permanent establishment? F, foreign, P is a permanent. Foreign permanent establishment dealing Article 24. So anybody would like to explain this part? Place of business, foreign company head office outside UAE. Guys, I appreciate, show your activeness in this discussion, because this is a very interesting topic, and it will be a very, even your professional discussion or communication, such thing will be very common to you, discussion point. Foreign permanent establishment is a broader definition, but we're going to understand company who have the place of business in outside UAE. Can we say the branches are the part of the foreign permanent establishment? Can we say the head office, one of the participants mentioned, because branches, mostly we will understand the branches, but the definition is beyond that. But let's keep here the branches. We will discuss this next. Apply, foreign branches apply for exemption election. We will have the double tax treaty agreement, where I recently did one client assignment, that was the double tax treaty agreement, the comparison and what are the impact assessment for the company who is based in UAE as a on real basis. So I'll share that experience also. I'll would like to share the practical. I did the UAE and the Indonesia double tax treaty agreement assignment, and what are the double taxation relief, and what are the advantage and disadvantage as a practical scenario that I recently did in the last week. So I would like to share in the coming 1 or 2 session, when we're going to discuss the understanding of the PE permanent establishment. We will cover all that part. But here our this topic is for the exempt income. So we are highlighting that what is the exempt income, but it will be enough detail to understand today also. Now we are seeing the branches are the permanent establishment, foreign permanent establishment. The definition is beyond that. Definition is beyond that, but anyhow we'll discuss. UAE company having the branches, UAE company having the branches. See here, the UAE company having branches in the foreign countries. This is the part. So now if we're saying that we want to opt for the election, okay, exemption election, can we, is there any criteria? So we will say, yes, we can make the election or we cannot make the election. Normally the option is that, yes, we want to make the election, we don't want to make the election. But here one additional criteria is there. If you meet that criteria, then you can make the election. Otherwise, you cannot make the election. So anyone would like to share his understanding, if previously have the go through this part? What are the additional criteria? here they think you can opt for the foreign branches to exemption election subject to if the country, we took the example foreign branches, I'll take the words, we just taken the example of the UK. So what is the criteria here? If the taxation is more than 9%. In that country, if the tax is more than 9%, then we can make the election. But if we take any of the, like the country, Panama, I'm not sure, but I'm just mentioning the name, Bermuda. So let's assume that their taxation is less than 5%. If such countries where the taxation is less than 5, then we cannot make this election. But here, if our like UK, so if we have taxation, we know the more than 9%, yes, then we can make the election. So this is one of the condition. So first we have to meet this condition, then we can see, okay, now here, what is the concept? Why here we can make the election and here we cannot make the election? What is the idea? What is the understanding over here? So the main logic is that because UE taxation up to 9%. If you already paid the 9% in the foreign country, so as per the double tax treaty and as per the OECD guideline, so there is some double taxation relief. So we can claim the relief if we paid overseas tax on the in overseas jurisdiction through the branches or through the PE or through the whatever the source of operation or the activity or the income you paid that, so you can claim. Now here's a very important part. So we all know 138 countries approximate or plus. So far we have the DTA or DTT, double tax treaty, or the double tax agreement. So we are familiar with the both term, but mostly they use the double tax treaty. So here is the one very common point. If we know that double tax treaty agreement exists, so then we can claim the relief. But here the UE tax authority is saying even we do not have the double tax treaty agreement with any country that you are dealing as a part of business and you are having paid the tax, he saying you can still eligible to claim foreign tax credit relief. But how much? In UK, the taxation for the corporate is, if I'm not wrong, 18%. Let's say so if we already paid the 18% on the foreign source income. On the foreign source income in UK, we paid 18%. So now we're gonna claim the foreign tax credit relief. So what UE is saying? UE is saying if you want to claim the foreign tax credit relief, so then you have to how much the relief you can claim? Up to or equal to 9%. But here we already paid the 18%. So can we get the balance 9% from the FTA, from the UE? The most of the participating saying no, but no refund. Can we carry forward to the future year? So what will happen with this balance foreign tax credit? Okay, guys, uh, we cannot claim the refund from FTA against the amount that we paid in overseas jurisdiction. FTA will never give you what the tax you paid outside. He's saying you just claim the relief against the foreign in-source income up to 9%. But if you paid excess, I will not give you because you did not give me the money, so I will not give you the back money. Okay, you paid for foreign and fine, but I'm giving you the relief equivalent to that. But if you paid more, I cannot return the money. I cannot return the money. And you cannot carry forward also. So this balance, the balance will be forfeited. Balance will be forfeited and it cannot be carried. There is no carry forward provision or carry back provision. So they're saying, okay, khalas, whatever is done is done. But normally, there is a less chances we will get the even because all over the world the taxation is more than 15%. That's why the pillar 2. That's why the pillar 2 is already implemented from January 2015 on the MNCs. Why? Because the worldwide the minimum taxation is 15% and UAE is 9%. So which means so we always paying more in the foreign jurisdiction. But as a part of the city competition, we have to add the foreign income, the foreign source income into UE source income or UE income. So we have to add. This is the UE income and this is foreign source income. For city competition, we will add all over the income for the foreign branches also. And then we do the city competition. And once we have the tax payable, then we will take the relief. Here you will not understand, but I have some example for that. Hope now you understand that what the concept here apply for the election. Yes, if we are paying more than 9%, one of the condition, we can opt for this election. We can opt for the election. But this is our choice. Our choice. Yes, the natural resources is 20%, and it's mostly in other Emirates is already 20%, or maybe it's more also based on the each the natural resource. It may vary also Emirates to Emirates, but recently Sharjah is announced 20%. So this guideline this. Okay, the foreign source income we already discussed is Emirates level taxation because this natural resource is falling under the exemption. Okay, so that we discussed in I think 2-3 session before in detail. Anyhow, so now the Mr. Asif asking if we paid someone paid here in UAE and he want to claim in the foreign jurisdiction. I'll give you the example for that. Okay, first let's understand. I think the first UAE you already understand. I'll give you the another example where the taxation is foreign jurisdiction. We paid the 5%. Let's understand this one also. Any part of the world, let's say X country where the taxation is less than 5% and the UAE is 9%. If UAE is the 9%, so first you will calculate the computation on the total income, foreign income plus UAE income, the same, you have the taxation, then you apply the 9%. Then we have to see the how much the UAE tax on the foreign source income. Here is the 9%, just for understanding. And already we paid the 5%. So which means, so balance 4% we gonna pay here in UAE. because whatever the amount is appearing, now we have to see the UE tax on foreign source income and foreign tax on the that income, whichever lower of will be exempt. But now if you paid the 5%, so the authority is saying pay the balance 4% here in UAE. So now, Mr. Asif, you understand your point. If he paid in UAE and he want to claim in foreign, then the taxable is the foreign. And the foreign is paying a local country. Let's say that from UK perspective, if the tax is 18%, that taxable person working in the UAE also through the branch, so he paid 9%. UK will say, okay, in UAE you paid the 9%. In UAE you paid the 9%. Now the balance pay in UK. Balance pay in the UK. Okay, thank you. But for the time being, I appreciate if you just keep the taxable person in UE perspective, okay? But vice versa, the story will be same. Okay, now we said, yes, we can make the election because we are meeting the condition. Now the next step, now we have the option. Can we make the election or we cannot make the election? Can we make the election or we cannot make the election? So what are the criteria? What are the criteria? Because the worldwide, maybe we have different permanent establishment. I'm using the word branches. So some will be profitable and some will be loss making. So now we want to make the opt for the election. We want to opt for the election. So we'll make the election based on what? So election means, if we say yes, election means we are opting for the exemption. We opting for exemption. What we are saying, we will not subject to tax on the branches. We will not. This is the election. If we opting for the election, we are saying yes. So what we are saying, foreign branches apply for exemption because our foreign branches, election means foreign branches profit will not be subject to tax in UAE. This is the election. Let's say in the foreign you are paying the 18% and U is 9%. So even you make the, if you do not make the election, still if the story is same because you already paid the 18%, here is the 9%, you are not gonna pay any additional amount of tax in UAE. If this is the scenario, to make the election or not make the election, it have the impact. Is there any benefit? Guys, please let me know, is there a benefit to make the election? We will see in detail is beneficial or not beneficial. But what the point was here, do the business analysis. It's good for your business because it may vary business to business. It may vary business to business. If you have the more loss-making branches, so see accordingly. And if you have the more profitable branches, and look accordingly. And then you'd make the election. But normally, as just for the understanding purpose, if your branches are profit making overall, because you have the 10 branches and overall the profitability is more, you make the election. It's good to make the election. Okay. Now, if you make the election, so which means you are not subject to tax in the UAE, So which means you are not claim the losses also here in UAE. You are not take the foreign tax credit relief also in UAE. If you are opting, then you are not eligible anymore for the foreign tax credit, foreign tax credit relief. You are not eligible anymore. If you opt for the election, then you are not eligible because you are saying my profit is not subject to taxable. Then your the loss is also not subject to here, and you cannot claim the foreign tax credit relief also. Now the losses, if you are having the more branches in the worldwide making the losses, because if we're gonna discuss in detail this concept, then we are coming into the accounting, because our tax part is finished up to here. Our tax part is finished up to here. Now whatever this below we are discussing, this is the accounting part. This is the accounting analysis. Based on the accounting analysis, based on each business, we will do the due diligence. We will then we come to know we can make to make the election is beneficial or not to make the election is beneficial. If we say yes, make the election, then the profit is not subject to UE taxation, then we do not have the foreign tax credit relief also. But if you are not opt, then the profit subject to UE taxation and you have the foreign tax relief. Yes, this is the irrevocable. Yes, this is the irrevocable. This election, see, the 99% election are irrevocable. 99% election are irrevocable. Only 1%, on why of saying 1%, only one election that we will see what is the one election that is revocable and under the which scenario it is revocable. But in generally for understanding, yes, the most of the election are irrevocable. Anyhow, let's move to the one of the participant asked Ms. Rana asking for the example. We will go through in letter and you will understand that part. But if you're saying the analysis which is good for us, so this is a long discussion. We have, but we will try to cover that. Let's cover this. Now we made the election. Yes, do not take their profit and losses into consideration. In UAE city computation, we will not add their profit or losses, which means we will not add their income, not their expenses. Election made for all branches. This is another point. We can, if we opt for the election, then we have to opt for all the branches. We cannot say, okay, some branches is profitable, I will not include in UAE city competition, and some is losses making, I'll include in the UAE competition. They said no. Selection is not available, means choose some of the branches, option is not available. What is either all or either none? If you are opting for election, you have to opt for the all branches. Election made, then no foreign tax credit relief. If we opt for the election, no foreign tax credit relief. Okay, how will take the foreign tax credit relief? No double taxation, because he paid the tax in the foreign jurisdiction, so he want to claim in UAE. So this is the foreign tax credit relief. Hope you understand. I already explained that part. So how he will claim eligible? How he is eligible based on the double tax treaty that I already mentioned that. Double tax agreement also some jurisdiction they is using, but mostly double tax treaty agreement treaty. Now the fourth exempt income, non-resident person having international transportation in UAE. I appreciate if any participant explain what is this fourth exemption. Please try to explain this fourth exemption. Non-resident person having the international transportation. So non-resident person. See, now you are active now. Mr. Raja, I think the first time I seen your name. Uh, okay, yes, this is the same concept. This is same concept. Let's say we take the Emirates airline. Emirates airline is operating in UAE also and in the other part of the world also. If we because certain industry operation our business are the worldwide they are operating, so and the different rules and regulation based on the industry nature also. The non-resident person, what the non-resident person means, the company in UK, right? Definition: having the international transportation. We already said the Emirates airline, Etihad airline. So now the tax authority is saying reciprocal. What is the definition of reciprocal? Would you please let me know what is the definition of reciprocal? The reciprocal, okay, the word reciprocal, the principle of, because this non-resident person having the international transportation in the UAE, it work on principle of reciprocity. Reciprocity. This is the whole concept under this non-resident person. Reciprocity. If the Emirates airline, I'm just gonna write Emirates airline. And give me any airline name from the UK. Give me any airline name from the UK. British. Okay, I'm gonna say this. These two name I got it. This is UK and this is UAE. The international transportation, the two part is covered. The international transportation is by air plus sea. The word road is not there. The word road transport is not here. There is no reciprocity, this international transportation for by road. Only these two topic is covered by sea. And now you're saying, okay, if the company operating and the Emirates airline is going to the UK, Emirates airline going to UK, and they are operating there. So whether the UK giving the exemption or no, he's saying, okay, UAE based airline operating here, so I will not charge the tax on this source because this is source now, source of income. Now you will understand one concept of the income. This is the for UAE company, this is the foreign source income. For Emirates airline, this is the foreign source income because this Emirates airline is registered in UAE, now is operating in the UK also. So he have foreign source income. So what authority is saying, if the UK will not charge the tax, UK will not charge the tax, okay, on our businesses, on our airlines, then we will not charge. Okay, so now they are coming here also. They're saying if they are not charging, there no tax. Okay, then you is saying here is also no tax. UAE is not saying I will not charge tax to Emirates airline. Emirates airline, their whole income subject to city. But they're saying if the the UK, they will not charge tax to the Emirates on their foreign source income because they are operating in relation or they in cooperation with the UK authorities also, UK airport also. So they'll say, okay, this is the Emirates airline, UAE resident, so will not charge the tax on his source of income. So versus the UAE authority, they will not charge to the British airline also for the UAE source of income. But Emirates taxation subject to taxation in UAE and British airline subject to taxation in the UK in their worldwide income. So this is the whole concept of reciprocity. If this is the in place, okay, then it will be exempt income. It will be exempt income. See here, what I think that what is the taxation on the airline? There is no separate taxation on the airline. 9% for the Emirates airline in UAE, except if he meeting the criteria of MNE, right? If he's meeting the criteria of MNE, then it will be subject to 15%. Pillar 2, but that is from 2025. But the UAE will charge the tax on the Emirates airline. They're saying if they are operating or they have the source of income from UK, UK will not charge to the Emirates. Because if UK will also charge and UAE also charge, then there is a double taxation. Then there is a double taxation. To avoid this, they said you will not charge on our international transportation, and we will not charge to your businesses also on the same industry on the reciprocity basis. On top of that, they're saying if you are providing any support function for the repairs, let's say the sea, and see if some ships are the now okay. I'm just taking the example of the sea transportation. The word port we can use, and there is some if the ships are coming, there is some repair and maintenance. Ships are coming, some repair and maintenance. They think whatever the industry associated with that, that also will be under exempt. What are the activities? What are the activities to having the international transportation? Okay, that also under the same. They are giving the repair, they are having the parts, that industry also coming under the same criteria. So this is the again additional point that I'm sharing here. Anyhow, let's there is one question: if UK is charging Emirates, then British airline is 9%. See, then the taxation will be different. It's the Bukhari the see. As of now, here is our understanding is that if this principle non-resident, what is our to the topic exempt income. Okay, under exempt income we are saying if non-resident person having the international transportation in UAE on principle of reciprocity basis, okay, because UK is not charging to Emirates airline, they're saying yes, the non-resident person is doing the business here, we will not charge tax to them. This is the concept over here. Now, if the UK is charging to the Emirates airline as per their regulation, fine. They will say, okay, fine. Now, the British Airways, they are coming to UAE, they will charge as per the UAE regulation to them also. Now, the concept is that here we will pay the 9%. So, it's beneficial for the British Airways. It will be beneficial because there in UK is paying 18%. Right? No. He will pay 9% here and the balance will be 9% in UK. For British Airways, there is no benefit. So it will be, see, the worldwide, each country, they are ensuring that the if foreign businesses is generating revenue from them, it must be subject to taxation in that country. There is another example. There is another example. I'll give you the Netflix, Google Drive. What are these activities? They are subject to taxation in the UAE. This is called the digital PE, digital permanent establishment. This is the digital permanent establishment, because they are generating the revenue from the UE user. If they are generating the revenue from UE user, okay, so then they have to pay the tax on the UE source income. Now this is their source. This is their source. They're saying, okay, on that source, you are subject to taxation in UE. But normally the worldwide on such source, okay, this is the another discussion is on AECD on such businesses, US source also, this the digital economy. The word digital economy, as per OECD guideline, yes, there will be subject to taxation. Okay, how much that we will see. Now, currently, the what is the withholding tax in UAE? What is the withholding tax in the? You guys know how much the withholding tax in UAE? Yes, currently withholding tax is 0%. But in future, it will be subject to 5%, 7%, 10%, or based on the different criteria. Okay. So now they're saying, yes, these businesses who are generating this foreign source of revenue from here, they will subject to withholding tax. And usually it starts from 5%, commonly in the worldwide, but it's more than that also, but it's starting from the 5%, 7%, 15%. But currently is a UE 0%. Now we understand the digital PE. So now here we are saying the foreign permanent establishment. Now we can say the foreign digital establishment. You understand the branches. Now you understand the digital PE also. On the same also the service PE also. There is another concept of service PE also. Foreign permanent establishment. Here we just familiar with the word of branch, but under the same definition, such things are also coming. Such things are also coming. Your store, okay, your factory, your warehouse, okay, but that is, I'm saying the service PE. Then there is many other terms are using. Once we come on the PE, then we will have the detailed discussion, and then you will understand how this whole topic, whole concept is working, and how the which way is beneficial us. Because normally, if you are PE, let's say if you are PE and you are paying the in general foreign source income, if you are service PE, then there is a agency PE also. What is the agency PE? Anybody would like to answer what is the agency PE? Agency PE, you are providing service in another country through your employee. You send your employees over there, they are working over there, and you are paying them, you are delivering some project over there. You take some local employees from there. If you take the local employees from there, that is the agency PE. Now, under the agency PE, we have to see the what are the additional conditions. Based on that, it will be agency PE or no. We have to see independent agent and dependent agent. So that such thing will go through under the PE topic. Let's move to the next. Okay, now the same concept that we go through, but I'll try to complete that part as today. Branches, So under the branches, we are seeing the local branches. What are the local branches? We are normally, the word branch is a separate juridical person. Even the local branch or foreign branch, they are the foreign juridical person or the extension of the business. The branches are normally is not separate juridical person. They are considered as the extension of the original business or the parent business. So branches will give us the profit. They will not give us the dividend. Branches will not give us the dividend. They will give the profit or the loss. Either profit or either loss. There is no dividend. So if we are discussing the foreign permanent establishment, so we are opting that, so we have to take both in our consideration for city competition. So they are considered as a single entity. All the branches in the worldwide, they will be considered as a single entity. But here the foreign permanent establishment, which means the local branches will not come under the same definition. The local branches will be considered as a single entity. Even you are opting for the foreign permanent establishment exemption. So under that, this will not come. All the local branches will be considered as a single entity. Hope this point is important for you guys to understand. Now the foreign branches. So what are the foreign branches? Just now we have some understanding. So I'm just going to refine that. We already understand this concept. Foreign branches, we've seen if we have we are paying the 9% or more in foreign jurisdiction, then we can make the election. Okay. So now we have to say whether we make the election or no, whether election made or no. What is the next point? Let me complete this part. Okay. Further election. So first, the election eligibility condition. What is election eligibility condition? Foreign countries where the taxation is 9% or equal to 9%, then we can make the election. Then we can make the election to exclude from the UECT. If we make the election, yes, then ignore profit and losses of foreign branches. If we made the first, this condition is met, then we made the election. If we made the election, he's saying, so next step, ignore profit and losses of the branches. But if we did not we did not opt for the election, then we will include the profit and losses of the foreign branch, all worldwide branches into city competition, into UECT competition. Okay, now the next part, let's cover that also. This is the what I'm saying that recently I did the DTA. Okay, the same foreign border transaction with Indonesia. So this is the recent exercise of the activity. So I'm just gonna share with you. Okay, so let's say here the understanding how it's gonna work. Our point of understanding is foreign tax credit. Here our point of understanding is a foreign tax credit. Let's assume that he have UE tax 9 million. I did not put anything here. Okay, so taxable income is 120. Now 120, how it will work? This computation may be not correct because I just put the random figure. So you guys just calculate what is the final tax liability in UK, in UAE on taxable income 120. Please let me know quickly. What will be final tax liability calculation? This is the taxable income. You have to apply the UECT rate to calculate the tax liability. Quickly, guys. Now calculate, please. Please calculate now. Because you guys see still some people mention that, okay, the city tax liability. It's the Bukhari. I would like to request if you would like to come forward and explain how you reach to that amount, 10,800. I appreciate to see we are together here learning. Even the mistake anybody can do that, but the objective, if we discuss that, so maybe other people also learn from that. I'm also the student of the taxation. I'm learning from you guys also. When you raise the question, I'm learning from that point of view because you're all the professional have the the unique capability. The same you have the different way to to look into the matters. Okay, and here let's continue because time will be getting out. So most of people give the answer. I'm just taking the same. So as of now, we have the 310. Let's say we can write here 31,000. Okay, so now here the next. Foreign cross-border transaction. Any country. We are not considering any one country, but here because I did the recent, so I took this just for training purpose. Add over here the slide from there. Okay, the foreign tax income and the tax paid over overseas. So first we have to see foreign determine the foreign income. How much the foreign income we have and how much tax we paid. Identify the taxable income earned in the foreign country. So which means whatever the, let's say for easy understanding, invoices or the contracts. So we will have the information from that. Okay, so this much income we generated and this much the less is the expenses also. So invoices are contracts, we have the revenue, then expenses, then we have the foreign income. What is the difference between the taxable income or the foreign taxable income, total taxable income? What are the definition of that? The income we are referring how much the revenue we generated or the net profit we generated from there. What this mean? The word foreign taxable income. This is the revenue or the net profit we can say them. The word foreign taxable income. So which means if we earn from the overseas country, so maybe we have some expenses also. So first we will see how much the income and associated expenses, identify the total taxable income earned in the foreign country, then we will see how much the foreign tax paid. So let's say the common taxation that is paid, that is the withholding tax. That is withholding tax, and mostly the withholding tax start is mentioned the 5%. Even this Indonesia is they have I think 20% or 15%, but the based on the DTA double tax treaty for UE companies is 5%. So my scope of that this assignment was to ensure how much the withholding tax or the taxation in the Indonesia on the UE company want to operate in India, in Indonesia, how much the taxation over there, and what are the supporting document they needed. Okay, so how much the credit relief they can get from here. Double tax treaty, because still the another very important or common point, we have the double tax treaty with the more than 137 countries. But if you go and see, maybe all is not effective as of today. Maybe more than 100 is effective, or maybe more than 50 is effective. Effective means rectified by the both countries. Double tax treaty, the agreement once they made, and then they said to the government, the other country government, and they, so after their signature, after their diplomatic, the channel, they signed and sent back to the same country, and you sent back to that country. So they are saying that ratified. Okay. So if they ratified, then it is effective. It is effective. Now, only is saying on this date is they ratified. They're saying after that date, 1st January, following that date, 1st January, from that it will be onward is effective. Then you can claim the effective date after that. Now, the another thing, what are the documents they're saying? To have the to take the double tax treaty benefit, they're saying bring the tax TRC, tax residency certificate. Tax residency certificate, FTA is providing the tax residency certificate to facilitate such matters, to facilitate the double taxation. So you can submit to the FTA, okay, on their portal, log into their portal and submit the required document, and they will be issuing the foreign tax residency certificate. Based on that tax residency certificate, you go to another country, like in this, you go to Indonesia and say, yes, we have the double tax treaty. This is the effective, this is the reference, our class is this, plus this is our TRC. If you give this document, then you are eligible to the 5%. This is the reduced rate. If the double tax treaty is not there, this is subject to 20%. In different country is a different. But you just take the overall idea how it's working. And moreover, the previously tax residency certificate was issued after the end of the financial period. So far, anyone apply the TRC? You guys have any experience to apply the TRC? Guys, quickly, yes or no? Yes or no? Guys, I appreciate if you guys respond quickly. Okay, earlier it was very complicated and much document they are requesting. Okay, but currently it's very easy. You can apply within 5 to 10 minutes. Okay, and the documentation requirement are very basic. Okay, the TRC, you can apply the TRC, and you can maybe this next day you will receive the TRC. Then you can give to the other country, and now the give to other country and take the advantage of double tax treaty, and maybe the zero exempt or maybe the reduced rate. So now the another point I'm gonna ask you, skipping this point. Yes, previously it used to, you can apply the TRC. You can apply the TRC upon completion of the financial year, 12 months. Okay. and you are completing the 12-month, then you have to submit the audit report or the financial statement to get the TRC. But now they said there is no audit report requirement if you are already operational, not for new company, but if you are already more than 12 months in that country. So for those companies, you don't have to meet the 12-month condition. If you are already a UE resident, then after 3 months of the relevant financial period or tax period or accounting period, let's say your tax period is January to December, then upon completion of March, in first week of April, you can apply for the TRC for 2025. For the 2025. So normally what was the practice before? They're saying, what was the practice? Once you complete the 12 months, then you apply for the TRC, you receive the TRC, then you give to the another country. So that was very, the complicating, and the mostly people are losing the advantage of the double tax treaty. What's happening if the country is deducted the withholding tax because he did not have the TRC? That because every year, because TRC will be issued for only one tax period. For only maximum for one accounting period, the tax period they will issue, but you can apply next year again. Okay, I was explaining, if you submit on time, then you take the advantage of the reduced rate. And your discussion will be keep going on, but we have to cover today's topic also. Let's come the first one, identify from the revenue and all the calculation. You may have the separate calculation. Then you have to list on how much tax you paid. Then calculate the domestic tax on the foreign income. Like if the amount that you paid over the overseas is 50,000. Now they determine the foreign tax paid on that income. This we already determined. Calculate the domestic UE tax on the foreign incomes. That because we added that income here, expense is here, that income, taxable income is here. So now here we are calculating the taxable income. So this is the taxable liability. Okay. Once this tax liability is coming, after that we will see, okay, the lower of, okay, the lower of, what is the lower of? Foreign tax credit for the tax paid in the foreign country. Okay. So let's say the 5% tax they paid being actual amount and paid in foreign country, we are saying the 50,000. So this is the actual amount paid. Now we have to calculate how much the tax on the foreign income in UE, right? How much the tax, see here the final tax liability is coming here. Now we have to see the total taxable income, because this I changed earlier, it was 120. See, this is the total taxable income. This is the foreign tax liability, tax liability is here. Then the taxable income is here, right? So now here we have to see how much we will pay in the foreign jurisdiction. So lower of, we have to calculate the lower of, because we don't have so far here the foreign taxable income. So we paid 50,000. So let's say you can give foreign taxable income means the profit. 120 is the total profit. So how much? Let's say the 70,000. Let's assume that this is 70,000, but overseas we paid the 50,000. This is the foreign taxable income, means the profit, right? So how much the profit we have? What is that? Foreign income minus expenses. So then it will be coming here. We need to keep all this calculation. We need to keep all this calculation and show here, okay, Now that this is the total profit, this is the foreign profit, and this is the UAE taxation. We're gonna make the apportion and we will see how much. Just quickly make the calculation, give me the answer, how much the amount is coming. How much the amount is coming, please? Currently, we have the one is the 50,000, and from here, how much it will be? 29,000. I'm just taking the round figure. So what we need to do, how much the foreign tax credit relief we can claim? Lower of. Okay. The lower of mean actual foreign tax paid and domestic tax liability on foreign income. This is the lesser or the lower of foreign tax and the domestic tax on foreign income. So now here is the 50, here is the 29,000. Which one is the lower of? Which one is the lower of? So here we will say 29,000. This will be our relief. This will be our relief. From this amount, we will minus this amount, and then will be corporate tax payable. Okay. Lower of is a minus. Then after that, corporate tax payable will be there. And if any excess, what is the excess here? Almost 21,000. So 21,000 will be forfeited. It cannot be carried forward, cannot be carried back. Hope this whole topic is you guys understand that. This is the example also. Sorry, the formula, calculating formula also. But we already covered this. We already covered this. Foreign investment. Foreign investment. Okay, the foreign investment. The word foreign investment, let's try to cover this. Okay. Foreign branches. From foreign branches, we take into account the profit and loss from the foreign branches. Foreign permanent establishment exemption is available. Yes, is available. Now let's going to apply. We are going to apply the foreign permanent establishment exemption under Article 2, city law under Article 2. Yes. Going to apply, yes. Then if we apply, ignore the profit and losses of the foreign branches, no foreign tax credit relief. We already discussed. Then we not going to apply. If we're not going to apply, the subject to profit and loss and foreign tax credit relief and double taxation. This is the double taxation, and this is the lower of UAE tax on foreign income, foreign tax on foreign income. Hope this point now you're gonna understand that. Now the foreign subsidy is a dividend from, we will get the dividend income, capital gain, participating interest exemption. We can get the participation interest exemption. Hope you understand what is the participating interest exemption. This will be deal as per the Article 23 of the city law. Okay, now let's go the exception for the registration for the corporate tax. This is the one point I just want to share. The ministerial decision 43. I already shared the link with you guys, and this is the, I just took the screenshot from the same ministerial decision. I'm just gonna focus, but the complete ministerial decision you can go through. This is not very big. Exception from registration for corporate tax, because we are discussing the foreign permanent establishment exemption. Okay, we discussed the foreign source income. So this is the point I'm gonna highlight to you. Non-resident person that drive only state source income under Article 13 of the Corporate Tax Law that does not have a PE in the state. State is UAE according to the provision of the Corporate Tax Law. So now he's saying if the UAE resident person drive only state source income under the Article 13 of the Corporate Tax Law, so he's not subject to permanent establishment. He's saying it's not subject to the tax registration. If you have the branch, okay, and you are generating the profit and revenue from there, you are subject to tax. But now they think there is no branch. You have only source of revenue. Source of revenue. In terms of Netflix, we discussed that is a source of revenue. For Netflix or the Google Drive, this is the source of revenue. So far, he's saying non-resident person that drive only state source income under Article 13, they are not meeting the PE, permanent establishment, for registration under the city taxation. Hope this point is understanding. Guys, so far the topic is productive for you guys, making the understanding. Guys, quickly. Okay, the next topic is cabinet decision. Cabinet decision on the determining of the annual taxable income. Determination of the annual income subject to city. So what is that? Here we have to just see the first 375 is a zero rated. The taxable person not exceeding 375,000 shall be subject to taxation at the rate of zero, irrespective of whether the taxable person conduct multiple businesses. This will be in case of the sole establishment. Okay. So this is just gonna show that this is first 375 is a zero rated, and on top of that is a 9%. But further detail in the cabinet decision 116, you can go through that. Exempt income, topic 5. Exempt income dealing Article 22 of the City Law, Article 23 of the Participation Exemption Interest, and the Article 24 Foreign Permanent Establishment Exemption. I think two already shared with you guys. If not, then you just go search and read this from the City Law. See, we cannot cover all the articles or the ministerial decision, but all the discussion what we are discussing under this training taken from such sources. While going through this training session, you go and read the relevant article, you already know the story. You already know the overall clauses. It will be much meaningful while reading that. If before this training or before such session, you are reading as in, just reading, you are not understanding, you are not absorbing anything, but now you can you have the digestion, you can absorb that legislation. Exempt income, dividend income, we already go through, but the dividend income from the UE juridical person without any condition, shareholding less than 4 or greater than 5%, investment income 4 million. Now the second is the participating interest in company in which having the ownership interest. So we'll continue this part, try to cover, then later on we'll see over here. I'm not gonna focus over there. Let's quickly. So we're gonna cover this section. Okay. This one we'll cover later. Now let's see. The first point, dividend income. Okay. The dividend income from the UE juridical person without any condition, shareholding less than, more than, investment less than, more than, is exempt income. Now, next, why dividend income is exempt? Now, one of rationale why the dividend income is exempt. Dividend is paid or dividend received at a time the company may have the dividend paid or may have the dividend received or may have the both. Okay. May have the both. Is already taxed. Anybody else want to answer on that, why the dividend income is exempt? Quickly, guys, I would like to see your participation. Somebody else want to give an answer, please, quickly. Any participant? Okay, the one point is already you guys are known, but let's see and cover this topic. Now I'm going to see the next slide. So we are on topic 2 on this. Okay, the dividend paid is the expense of the company. If no, then we are saying the distribution of profit. This is most of the participant given the answer. Most of the participant is saying the dividend is the expense of the company. No, okay, which means they did not record in the profit and loss. Okay, expenses is not the expense. If not the expense, which means the profit is increased, more tax, already tax paying by the company. Okay, this income, mostly people mention the same point, is already taxed by the paying company. Okay, now if this is the scenario, yes, it's worked fine. Now another thing, dividend paid is expense of the company. Yes, it is the expense of the company. Under which scenario? We already discussed in the previously also under the share topic, but now again the same accounting touch is there. Accounting standard touch is there. Financial understanding touch is there. So our financial skill will give us the comparative edge on the other taxation or the tax agent also who are not from the accounting background. So keep that advantage, take that advantage, and try to upskill your skill in this profession. Redeemable preference share, debt or liability. Okay. So under redeemable preference share, this is the considered as a loan. This is the considered as a loan because you have to pay back. Under the preference share, okay, preference shares can be redeemable preference share or irredeemable preference share. So this is the redeemable preference share. This is the redeemable preference share. Okay. So redeemable means you have the deadline. You have to pay them back. Okay. You have to pay them dividend on priority. You have to on the ordinary share you will not pay, but the Here you will share the dividend. You are with certain date you have to return that, and normally maybe no voting right also. Maybe no voting right also. So which means this is the loan that we taken from under the name of the redeemable preference share. If we taken the loan under the umbrella of the preference share, redeemable preference share, then it will be our cost. Then it will be our dividend. Interest is our expense. Dividend is the expense. We're using the word dividend, but actually is the expense. It's not the dividend, it is the expense. If it is the expense, then it will be recorded in the profit and loss. So expense is increased, profit is reduced, tax is reduced. So now guys, you understand again the point why we are discussing that dividend is expense. You have to go through your scenario. What are the scenario under which you are receiving the dividend? Okay. If it's coming through the redeemable preference share in UAE, some free zone, they are giving you this option also. More than we are familiar, all the companies in UAE, they have the ordinary share, but some free zone, they have this option also, redeemable preference share also. So please review your data carefully, understand your analysis carefully, and move forward. Now the dividend paid, the category we said that 0.3, the dividend paid. Now what if we dividend received? What if we dividend received? Okay, already taxed by the paying company. This is most of us give the same answer. Okay, yes, paying company from statement of change in comprehensive. What is this statement of change in equity? Yes, if already taxed, which means the company is not adding into the profit and loss. Company is not adding into the profit and loss. So company not paying from the P&L, if they are paying from statement of change in equity from here, from the equity part. So which means it's coming after the tax, after the tax. So this will be exempt. Okay. Already taxed, no. If not already taxed, which means they paid from the profit and loss. They paid the dividend recorded in the P&L end. So we have as a tax person, we have to see the financial statement. All this effect is there. If it's there, accordingly we will prepare the corporate tax return. But if your financial statement is not done properly, not done appropriately, not done under the guideline of the IFRS applicable local regulation, then your tax accountant, tax consultant will file the return, will complete the return taxation, but the error will be there. Error will be remain there. Ms. Rana, you said did not get this. Which point, please? Which point? Which point? This one we are saying the fourth one. Okay. Dividend received. Okay. Dividend received. We have to see whether the company give this tax dividend to you after the taxation. If after the taxation, which means, okay, the word paying company is not because you are receiving end. Like we can say that Farhana LLC. If Farhana LLC receiving the dividend, okay, receiving the dividend from the X LLC, here is the F LLC, okay, you are receiving the dividend, okay, they are paying the dividend. So now you have to see, okay, they paid from the here. Let's say I'll use the word the equity part, the balance sheet part. If they are paying from here, which means this income is coming from the P&L end, profit and loss, which means if coming from profit and loss, but he paid from here, he did not record in profit and loss, which means he give after the tax. If he paid after the tax, it is the exempt. Exempt for whom? For Farhana. Because Farhana LLC receives this income, this is the exempt. Because who paid the tax? Who paid the tax? LLC is paid the tax. He gives the dividend after tax. Okay, this is the point. See, the word parent is the different. Okay, here we are discussing the participating interest. Okay, the word parent the accounting parent is a different, tax parent is a different. In accounting, we saying the parent company, in tax we saying the tax group. So we have the tax group rule is there. How many shareholding under the tax group? 95%. How many the tax group how many the loss group? 75%. How much the transitional loss group is a 75%. How much the there is another 50%, there is another concept. One more group is there. Tax group, loss group, transitional is group. Then the related parties. Yes, the related party. The related party is 50% for the city. Now on the other side, yes, the 50% directly or indirectly. On other side, in accounting, the definition may be different. We are saying the parent entity, how we are saying the parent entity, how we are saying the subsidiary, how we are saying the associate. These are the accounting names. Now, on other side, he's saying if the X LLC, on the other scenario, if we just take the example, if here the X LLC, I'll just take the same example, okay, F LLC. He paid the dividend and record in the as the expense. He paid the dividend, so which means, so this is the scenario is applicable over here. This is a scenario applicable here. In case of redeemable preference share, he paying the dividend, but he's recording as a expense. He's recording as a expense because it's a debt instrument. So which means now the dividend that you received before tax, if before tax, then it's subject to taxation. Then it's subject to LLC have to pay the tax on that. Ms. Rana, hope you understand the concept. Guys, you understand so far the topic? Okay, our time is about to finish, but let me see the next slide. Why dividend exempt? So hope you understand why dividend is exempt. Let's see the quickly. I'll just try to cover this 1 or 2 slides because this topic will be, at least one side will be covered. Okay, the point 5, investor. So who's the investor? Because somebody buy the shares, so there will be some investor, corporate investor and individual investor. If the corporate investor exempt income normally, okay. Individual investor doing business, unincorporated partnership or sole establishment, it will be taxable. From the investor point of view, who buy the shares, who made the investment, okay. So if the corporate investor, normally for them the income is exempt. If individual investor, so we have to see that doing business through the unincorporated partnership or the sole establishment. What we said the dividend received from the LLC company, juridical company. Juridical company will be normally the corporate investor. If dividend receiving from them is exempt, the word normally, okay, Now you may understand the why I mentioned the normally, because maybe the redeemable preference shares are there. If this is the case, then it may not be exempt also. Individual investors are doing business, unincorporated partnership or sole establishment. If you are receiving the dividend from such business, it will be subject to taxation. Okay. Now let's move to the next point, is 6, natural personal relief as per the Cabinet Decision 49. So what we're gonna see, the below incomes are the out of scope. Okay. Here all below income, not the above, all below income, even revenue is less than or more than 1 million, even revenue less than more than 1 million, no condition is there. Under natural person, wages and salaries, real estate income, under real estate income, rental and sales, personal investment. Who's doing this? Natural person. If natural person is doing this, he's getting the salary, wages, he have the real estate. Let's say the natural person have the hundreds of property and he's getting the rental income. Okay, he's getting the rental income or he's selling the property. This is the exempt. But subject he is doing as a under his natural person. These are the out of scope. The word out of scope is important. Okay, no conditions are there. Next is a natural personal relief. Okay, doing business via trade license. With natural person doing business via trade license, natural person relief is available to both resident person and non-resident person. Now here he's saying the natural person relief, doing business via trade license, natural person relief to both resident, non-resident. What is the condition? Revenue is less than 1 million in the calendar year from the accumulative business. In one calendar year, his revenue must be less than or equal to 1 million. If this is the condition, okay, then you can claim the SPR. While claiming the revenue for the SPR, you will not calculate the wages and salary, real estate income, investment income. These are the excluding income. Because if we know that to have, for natural person relief, okay, for natural, this is natural person relief. This is for natural person relief, okay, they will not calculate all this income, but they will include the exempt income. They will include the exempt income for the natural person relief as well as small business relief also, because these relief are based on the revenue threshold. Revenue threshold. How you gonna calculate the 1 million? Because you have to test the revenue. How you gonna test that? Without this income, but include the exempt income if any, exempt income. Okay. Then let's move to the next, excluding. Okay. Excluding, we already seen the 3 income is excluding and the 1 income is including. Small business relief is available if revenue is less than equal to 3 million. But if revenue is less than equal to 1 million, is small business natural person relief also available. The small business relief is available to resident and small business relief is available to natural person and juridical person both, or small business relief is available to resident or non-resident or only resident? Quickly, please guys, quickly. I'm trying to close over here, just quickly. Small business relief is available only to the resident. And if your revenue is less than 3 million. Guys, this is one of the point you guys have to, if you branches, if you UK company have branch here in UAE, they cannot claim the small business relief. Because they are running through the, because branch is what we are saying, extension of the main business. Okay, now this is the SPR is available to natural person as well as juridical person, and the natural person relief is available to resident and non-resident both. Okay, guys, I'm gonna close here. So before leaving, if you guys have any point that you want to ask, please let me know. Ms. Farhana have the question. I have one question. Not on topic. When we will cover the topic for Pravi and this one. Yes, it's coming, and maybe after 2 or 3 sessions, we are maybe reaching over there. We are reaching over there. See, now the most of the topic that base the foundation, we already covered our foundation. Now we are covering one by one the topic. So we will have the loss group relief also, tax group also, transitional relief also, business restructuring relief also. Okay. So now our next topic will be exempt income also. Exempt income we already covered. So now I think that one more topic that is coming there. So in next couple of sessions, inshallah, we will cover reach up to this that you are referring over that. So apart from that, any other question or the point that you guys want to ask? Okay, guys, thank you very much, and hope today you enjoy the session and you have the productive session. The time that you investing and the time I'm investing, it will be fruitful by the end of the each session, by completing overall taxation also. Thank you, guys. Have a nice day.